Ladies and gentlemen, welcome back to the Crypto News Podcast. Your host here, Matt. Today we are buzzing as always, guys. We get another Matt on the show today. I should have done the math beforehand. I think this has to be Matt number 15, 16, 17, 18, 20. I mean, if you had Catholic parents growing up, you had like probably a 20% chance of being named Matt. I could be putting words in Matty's mouth, but that was definitely the case with mine and most of the other Matts on the show. Guys, this one's going to be an absolute banger. Today we have Matt O'Connor on the show today, co-founder of Legion, a platform for compliant and merit-based public token offerings that enable teams to select investors based on criteria such as on-chain history, social clout, and developer contributions. He's the former lead algorithmic engineer for Bridgewater Associates, wowza, a tokenomics researcher for the Stacks Foundation, and token economics lead for Status, which ICO'd in 2017. His open source book, Tokenomics for Builders, has been positively reviewed by founders and VCs from Monad, Placeholder, Tensor, AllianceDAO, Galaxy Digital, and more. What a bio. Matty, pleasure to have you on. Love your name. Welcome to the show, my friend. How you doing this lovely morning?
Appreciate it. Doing well. Thanks for having me on.
This is going to be an absolute great one. And honestly, I feel like there's never been a better time to do a proper ICO in crypto. We've seen, this has been such a trendy topic for so long, and we're going to get into all this. I'd love to start with your past, and then we'll get into just a lot of the things ICO related, tokenomics in particular. Everyone's talking about tokenomics, how 99% of teams fail about that. And then, of course, who's on your cap table? Who do you let in? Do you let a bunch of clowns in who are just going to unload the clip right when their tokens have vested? You guys literally let companies source people out, on-chain history, social clout, developer contributions. That's what you want. This is like sort of picking your VCs, but they're not really VCs. It's just the public, which is absolutely freaking awesome. And I can't wait to get into this. Okay, we got to go back though. Bridgewater Associates, one of the best firms in the whole world. You were the lead algorithmic engineer. Are you a super quant? Like, how the heck did you snag that job? That is absolutely incredible.
Yeah, I wouldn't call myself a super quant as much as I'd like to, but I've always been someone who likes to tinker around with algorithms and design systems and predict the future. For instance, to give you a sense, back in high school, I'd be the kid that was playing fantasy baseball and doing sabermetrics, statistics on Oakland A's, Billy Beans style stuff, right?
Yeah,
so just modeling reality and expressing complex systems in algorithms and predicting the future has always been a passion of mine. As a kind of a side thing, as a hobby, I'll spit up prediction algorithms every World Cup, and I've always been profitable. We'll do a lot of stuff. When I used to have time before being a founder, would do a bunch of stuff of poly market type of things and other perp dexes, just funding rate arbitrage. There's so much out there that you can do with some fun algorithms, and that's the kind of stuff I'd like to do, is tinker around with complex systems. And so that lended itself very well to my time at Bridgewater. I was on the algorithmic trading desk. We traded anything and everything you can think of that's traded electronically. And so most of the job was actually sitting there watching an algorithm trade to make sure it wasn't going crazy, and then doing data science on the performance of the algorithm to improve it retroactively, right? To improve its parameters to make sure we're trading more profitably in hindsight.
That's awesome. I could see you. I was a big fantasy sports guy as well. I actually went to school at Brock University Sports Management, probably the best sports management program. And I thought I knew a lot about sports, but I was with guys like you who knew everything about everything and then had the technical side as well. So we used to do we would do a couple of us had Bodog accounts or Bet365 accounts, underage, weren't even allowed to have them. And we would absolutely rinse these guys because we had a group of, we had a Facebook group of about 100 people. Right. And it's all just sports lovers, a lot of quants, and we'd absolutely put these guys on the workbench and take them for a ride. So you would have been a great value add in that group.
Right. That sounds like fun.
It was a good time. Okay. Before we get into Legion, present day ICOs.
Yep.
ICOs, guys, for those who don't know, initial coin offering. It's the crypto version of an IPO, except it's a lot different. The biggest difference is with a traditional IPO, more of the structure and whatnot, and the nuances go to the bankers and the brokers and the broker dealers and how much you give them. It's pretty standard. You sort of just pick how many shares, are going to be outstanding and what is the price of those shares. There's really not that much that goes into it. There is, of course, the legality, blah, blah, blah. But in crypto, you get to pick your tokenomics. And we've seen it a gazillion times now. Tokenomics have a huge impact on your coin. If you set yourself up with good tokenomics, you have actually a chance to succeed. And if you don't, which is 99% of people, you're sort of hooped from the get-go. Before we get into Legion, why did you do this? What did you see with ICOs, tokenomics, and everything else that made you go, this is broken, I need to create something to fix this?
Yeah, it's a great question, and you touched on a lot of things that I'd love to delve into. I mean, to get a understanding of why we started this, you have to go back about 2 years, which when we started 2 years and a couple months. And at the time, we were right in the peak of kind of the airdrop meta, the points meta, right, where people were increasingly frustrated with VCs being the only ones that could get meaningful allocation, and then like, the community would get these like tiny, meager airdrops that always seem to underperform and disappoint. And so there was this need for rethinking different ways to distribute tokens. And one of the reasons teams can't give away airdrops that make people happy is just an airdrop is very inefficient, right? You're giving away a lot of resources for almost always very little benefit other than just purely a marketing expense, right? Airdrops don't convert into longtime users, don't convert into loyal community members. And so that was a problem. Plus, you had regulation like MiCA in Europe, markets and crypto assets, coming out soon that would explicitly, for the first time, establish a regulatory compliant way to do token sales, basically saying like, hey, there are these things called tokens. They're not securities, at least in certain cases. And here's how you could do a public sale of them. And so you had regulatory compliance coming online for the first time.
Yeah.
And so we spoke to like hundreds of founders, and all of them wanted to do sales. And the two blockers were, one, I don't want my funds to be frozen, or I don't want to go to prison, right? I.e. the regulatory side. And two was, how do I know I'm selling tokens to real people that I want to work with, right? If you raise from a VC or an angel, you know who you're working with. If you sell tokens to addresses, they could be bots, they could be Sybils, right? They could be just asshole, like, right? The people you don't want to work with. Part of my friends.
99% of them are, though. Like, genuinely speaking, it's wild.
Yeah, so you got to very closely vet these people. And so that's why we built out the two elements that we did. One, regulatory compliant focus from day one. And two, this reputation system we call Legion Score, which looks at your contributions across social media, right? Across GitHub, across all these sorts of aspects on chain, of course. And so teams can really optimize for the types of holders that they want to have. So that's kind of how we got to the initial vision when we started this 2 years ago.
That's wild. And how many, I mean, you guys probably get so many companies who reach out who you turn down as well. But it's such a no-brainer. Just to sort of set the stage for the folks who aren't too familiar with ICOs, how does Legion differ from sort of the traditional equity partners like the AngelList, Carta, Republic, SeedInvest, all of those guys?
Yeah. So this is a great question. And I love that you mentioned IPOs as well, because actually I think there's a little bit of a convergence of these two things that we'll continue to see. Yep. So, for those less familiar, if you go back to like 2017 was not the first ICO, but the first time ICOs really got popular, right? It was the first cycle of big ICOs, and you had teams raising literally with nothing more than a website many times, like hundreds of millions of dollars. And so it made a lot of people very, very rich. But as you can probably imagine, it didn't take long for scammers, right, and people like lower quality projects to catch on to this and start launching projects. And so you had a bunch of, people lose money, and you had a bunch of regulators step in and largely shut this down. And so ICOs didn't disappear entirely, but largely kind of died off, faded out a bit after 2017. And what brought them back again was regulatory changes opening up again. But the reason I start with that background is because there isn't enough kind of quality control and kind of like these standards, right, that exist in IPOs and other markets that didn't exist in ICOs. And so while ICOs are very different from the traditional equity plays, they're actually converging in the sense that you have traditional finance that is increasingly moving on chain and using crypto as the rails. And at the same time, you have crypto that is getting more regulatory clarity, right? You have MiCA, you have the Clarity Act in the US, you have, these innovation exemptions that the SEC in the US and Chairman Atkins has been talking about. So you have crypto moving to more disclosures and more regulated at the same time as you have traditional finance moving on chain. And so ICOs and IPOs, we think, will ultimately become one and the same thing effectively. We call ourselves actually the world's first ICO underwriter, where we work with teams and we help them think through exchange listings and finding the right buyers and market maker agreements and all these sorts of devil in the detail aspects that the average user probably doesn't think about when they think about a token launch.
Well said there. That is a crazy, I mean, I don't even think it's a hot take. I think you're pretty darn bang on there. Like with, especially, I mean, it's 2026. Are you telling me in a couple of years, the stock market's not going to be on at least 24/5, and then a couple of years later, 24/7?
NASDAQ's been talking about doing it this year, right? Like, yeah, we could see that very soon.
It doesn't make that much sense to not do it, unless you're a banker. And again, a lot of the big bankers do sort of run the world in some capacity. And, they probably after 4 p.m., they probably want to get on the helicopter and go to the Hamptons. I get it. I probably would too, to be honest. But I mean,
well, it would have definitely made my life at Bridgewater even tougher if the market's traded with 7, that's for sure. Yeah.
Exactly. But then again, now maybe you don't need a super quant like Maddie to stay late till 2 a.m. when you can have some pretty sick AI, algo or heck robot in a couple of years, who knows, monitoring the situation. So it's going to be a lot of fun moving forward. Walk me through the traditional process for Legion on the founder/team side of things. If you're a team, and let's say me and you are launching Mattycoin, and walk us through the process of us on the other end wanting to invest in Mattycoin. How does that whole workflow, UI, UX look like?
Sure thing. Yeah, I'll start with the user, the investor, because that's kind of, the simpler flow. So you would come to Legion, you would sign up, you would optionally, again, connect some of these external accounts, show off your on-chain activity, show off your social activity, show off your developer contributions, get warm introductions from people, get referrals from people, all this to kind of optionally, again, build up your profile and give a sense of who you are as a person, as a user, as an investor to projects that you're going to be applying to. Because again, we as we all know in crypto, one of the biggest challenges is that there's just a bunch of bots, a bunch of Sybils in this industry. And so Sybil resistance is a big piece of this that teams are looking for. So you would sign up, you'd optionally connect your accounts, and then you'd be able to browse, there are some jurisdiction restrictions to this, but you'd be able to browse kind of offerings on the platform or offerings that are coming up soon. And if you see one that speaks to you, we recently did sales with yield basis, sales with football.fun as examples. So if you saw a sale that spoke to you, you would complete a quick KYC, and then you'd be able to participate in that deal. It's pretty seamless. You send funds to a smart contract on chain, USDC, super easy, super simple. If you want to withdraw funds during the sale, you can do so from the smart contract. It's pretty painless. We've never had any issues with people, losing funds. Fortunately, knock on wood, no bugs or anything. And so we have a great track record with actually conducting the sales themselves. So pretty seamless process for investors. So you send funds into the deal, and hopefully you get your allocation. In some cases, like the yield basis sale, it was like 100x oversubscribed, right? It had like $200 million deposited. So not everyone, it's mathematically impossible for everyone to get their full allocation. So not everyone's going to get their full allocation, but hopefully you get yours. For projects.
And sorry, before we go into the projects, and a lot of that, does the team also get to decide who, can the team come in? Okay. So the team, so it's algo based in the sense of, you said like the social clout, the on-chain history, the developer history, plus sort of the team has a say in that as well. Those I'd say are the big 4 queries. Yeah. Anything else that sort of depicts who can get in and who can't?
Well, so to be clear, it's all these data points that I mentioned are information that is served up to the team. So they see about you, this is who you are. This is the type of on-chain user you are. These are the kind of ecosystems you have like social clout in or mindshare in. And then they're making the decision, right? So one project might say it's super, we're building an Ethereum DeFi aggregator. It's super important for us to find TVL providers in Ethereum, right, who have high mind share. This is an example, right? And another project maybe is building a AI agents platform, and we really want to reach Solana, chain users who are also developers, right? And so it's entirely up to the project to determine who they're selecting. Going back to the problem of like these founders want to be able to make sure that they're giving tokens to the right people for their project. If they don't have control over who they're distributing tokens to, the alternative isn't that they're just going to give everybody free tokens. The alternative is they're not going to distribute tokens more broadly to the public, right? They're just going to do what they did 2 years ago when we first started and only raise from VCs. And so community doesn't get anything. So that's why we do it this way. We call it merit-based allocation. And projects at the end of the day have control over who's getting their token, not us, not a syndicate lead or some other third party, the founders and the teams themselves.
Love it. Okay. Now let's go to the project side of things.
Yeah, so this plays into the project side of things where they're coming to us, they're signing up. We are a curated platform, so you won't find just any and every project on Legion. We like to have a conversation with them, understand, their pros, their cons. We have a bunch of investors ourselves that have backed Legion: VanEck, Brevin Howard Digital, Kraken, Crypto.com, Delphi, Cyberfund, which is Constantine from Lido, his fund. So a bunch of great investors that are able to introduce us to, portfolio companies and strong founders. And so we get a bunch of inbound. We look at them. We look at their on-chain traction. We look at their social traction. We look at their narrative. We look at the valuation, of course, all these things, and are finding, the best deals. And I'd say like 1% or less of deals that, are on our radar ultimately come to the Legion platform. And then once we're approved to work together, largely there's some boring stuff like, some regulatory stuff and signing contracts, but largely it's the fun stuff of planning out your sale, planning the co-marketing, and then getting off to the races of opening up your sale. People apply, as we just talked about, from the investor's point of view. And then you get the fun job of being able to determine, right, being able to go through all these people who want to buy into your sale. And this is honestly, this is the favorite thing from a founder's point of view of our platform, is them being able to go through. And if they wanted to, of course, you can't really feasibly do this when you have tens of thousands of people apply. But if you wanted to, you could literally go one by one through every application, read the cover letter, look at all the scores, look at the achievements, look at who referred them, right, and customize the offering to them. And so you're really, really maximizing for the quality of buyer, the civil resistance of the buyer, and who you're having as token holders. You're not optimizing for just raising money regardless of who it comes from. Even if it's all bots who are going to dump your token, you're optimizing for the quality and the value add of the investors.
That's electric. Oh, wow. Well, that's got to be a great feeling too. Yeah, that probably feels like, like OpenAI or Anthropic raising around, and you have every investor in the world knocking on your door, getting on their knees and being like, hey, anything you want, I got you. That's got to be a good feeling. That's awesome.
Yeah.
Okay.
It's definitely Founder's favorite aspect.
Maddie, you're on a roll here. Quick break and shout out to our sponsor of the show, PrimXBT. When we get back, we're going to keep buzzing. A huge shout out to PrimXBT, longtime friends and longtime sponsors of the Crypto News podcast. We love the team at PrimXBT as they offer a robust trading system for both beginners and professional traders. Doesn't matter if you're a rookie or a vet, you can easily design and customize your layouts and widgets to best fit your trading style. PrimXBT is also running an exclusive promo for listeners of the Crypto News podcast. Use the promo code CryptoNews50. That's CryptoNews50, all one word, to receive 50% of your deposit credited to your trading account. Again, CryptoNews50, all one word, to receive 50% of your deposit credited to your trading account. Okay, I want to go back to tokenomics.
Sure.
And I guess we'll touch tokenomics in one sec, but I don't know why this has been on my mind to get a pretty solid amount recently, Maddie, but the whole shit show and dilemma of foundation equity or company equity versus launching a token. You're one of the most reputable and respected people to talk about this situation. For me, I think it's pretty standard. Like, you start a foundation, it doesn't own any equity, or it only owns tokens. But I just don't understand how and why teams still do. And guys, sorry, I didn't set the table here. Let me set the table. There's a big problem right now in crypto where if Maddie and I want to launch a coin, first we're going to start Maddie Foundation or Maddie Labs, right? There's going to be an overarching entity that controls everything and owns, a huge chunk of the tokens until they go public, blah, 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 something like that. But also then there's the tokens, or the team is usually getting a bunch of tokens as well. So if I'm an investor, why would I want to invest in Maddie coin or Maddie token when Maddie and I, or other Matts who created it, also own equity in a company as well? You're not getting the whole pie. The whole pie should be available to everyone. That's the whole point of crypto. What's your 2 cents on that? Should we just be going token route only? Should we still do some splits? I don't know why I think about this a lot, but I'd love to hear your 2 cents on this.
Yeah, this is a great question. Appreciate you asking. The reason this happens, right, is that companies end up with both equity holders and token holders. You have to go back to incentives, right? The team wants to raise money when they're building out the product, right? And investors, you have 2 options, right? You could immediately launch a token and try to raise money that way. Again, do an ICO. But there are downsides of that. You're immediately publicly traded. Like launching a token, make no mistake, is a bunch of work. It's a bunch of distraction. Is a bunch of noise. And you're if you don't already have a product built out, there are obviously exceptions to the rule, but for most, vast majority of projects, if you don't already have a product built out that has some users, has some revenue, has some traction, right, has some mind share, your token price is just going to go straight down, right? And
Yeah.
so is it really beneficial long term if you want to build this company for you to just launch a token immediately? Like, you're actually setting yourself back. You're making it tougher to raise funds in the future. You're making it tougher
Yeah.
to turn the narrative around. So that's one option. It can work, but it's not, definitely cons. The other option is raise, VC or angel funds, right? And you can include community in that, but you're not launching a token yet. So what's the form of that investment? It's going to be equity, right? And the reason that it's not, well, some people ask like, well, why isn't it only future tokens, right? Or simple agreements for future tokens, SAFTs, right? As we've seen in the past. Largely, it boils down to incentives and legal protections, right? An investor like a VC is not going to want just this thing that, like, there is no legal protection around a token, right? Whereas equity holders do have legal protections. They do have,
Gotcha.
rights in the capital stack if the company gets liquidated or bought out, right? They do get a payout. So the VCs are driving this of like, we don't want to invest only in tokens. We want equity and then token warrants. And so you end up in this situation where unless a project is literally launching a token immediately, which is the wrong choice for 99.9% of projects, you end
Yeah.
up with this double stack. Now, it doesn't mean that there's no solutions to this, but that's why we find ourselves in this challenge of like one set of people who own tokens and another set of people who own equity. And if they're not the same group of people, then you have conflicting incentives and they're trying to argue against each other, and like Uniswap fee switch type of debacles, all this sort of stuff can,
Yeah. Well said. Tokenomics. This will be the toughest question I ask you, and this is one that I still don't think anyone's found a sweet spot. We've had tokenomics plus post ICO models. I think Hyperliquid has probably done the best job of that with how clean it was. Again, the airdrop, just to fortify your point earlier. If Hyperliquid doesn't make millions of dollars a day, they can't afford to airdrop all that money to token holders, right?
Yep.
So you need sort of that perfect storm as well. I'm biased. I love Hype. I'm trying to think of a couple other teams that have done it well. I also think the horizontal inflation a la ETH, a la Solana, I think it kills you as well. If you can go the capped route, it's great. But again, there's cons to that as well. Have you seen any teams recently, or do you have any teams, projects, foundations in particular, where you love their tokenomics? And if Maddie's launching a project present day, how do you design your tokenomics?
So tokenomics is funny. I mean, I've you'll hear a million different opinions, or you ask, they say about economics in general, right? You ask like 3 economists, you'll get 4 opinions. I think tokenomics is similar.
Yeah.
I've been around the block, right? I've worked with projects, multiple billion-dollar protocols on their tokenomics, written that guide that has been very well reviewed by many different parties. So know more than the average person. And I think I'm increasingly coming around to the opinion that there is no one perfect design to tokenomics, but there are common mistakes to avoid. So more about avoiding common mistakes than it is about like finding the perfect, these perfect theoretical tokenomics. And so mistakes to avoid generally are around, like distributing too much of your supply, launching a token too early, right? Having no value accrual or utility. I think especially these days, you've probably heard of the, the revenue meta, right? Which is just basically a fancy term to say, like, there's not much demand anymore for just this theoretical like token that's out there that supposedly has value merely because it exists, right? In previous cycles, we saw a lot of these tokens that assumed they would have value because they looked at Bitcoin and they said, oh, Bitcoin is scarce and you can use it to make payments. Therefore, if we launch a token that has a fixed supply and you can use it to pay for our product, it will have value. And that was just very
100%.
poor reasoning by analogy, where that's not the fundamental relationships, explaining that. Bitcoin is a very, very, very special case that you should not base your own tokenomics on. And increasingly, you're seeing, projects need to have some revenue. In addition to having revenue, need to have the narrative about value accrual supporting the token. So there are some really cool things. I think, projects like GMX with their escrowed staking rewards do very clever things to like minimize the sell pressure and like align, long-term incentives where long-term holders are still incentivized to stake, but short-term farmers are less incentivized to stake. So you get a higher quality basis of users and token holders. But I think all those are kind of like secondary level optimizations. The
Mm,
first and foremost, the 80%, if not more, is first and foremost building a product that people like to use, that people are willing
yeah,
to pay to use. You have
yeah,
revenues, you have a real need, and there's a strong value accrual to the token itself. And I'm not shilling my book here. It's open source, it's free to everyone, but I have a bunch of thinking and guides and kind of worksheets that you can read in Tokenomics for Builders and go through like mapping out all the incentives of people involved, mapping out the value accrual, seeing how these all fit together so you can start to plan this out. Because I can't tell you how often it happens a little bit less these days, but back in the day, would speak to so many founders that would just be like, I want to launch a token, and they wouldn't have really thought through the incentives or why people would buy the token. They would only think about bootstrapping their growth with the supply side.
yeah,
And that's
yeah.
the benefit of the token, but it can't be the only reason for the token.
Well said. I'm like, again, if you told me right now, okay, we're launching a token before the end of the show, swear to God, Maddie, I would go, you and I keep a very small amount, plus our other team members, very small amount. And I
Yep.
do believe the team should always hold tokens. They're the one doing all the work. They're
Yeah,
the
yeah. You
reason
gotta have some
why
incentive
the
around it,
users,
I think.
exactly, you
Yep.
gotta have, exactly. But I'm a big fan of like no vesting. Like launch the
Mm.
thing. If someone wants to, someone wants to unload a clip right off the bat, screw it. They can unload a clip, but flush out all the shitty holders, grow, maybe not slow and steady, but fast and steady with all of the
Yep.
holders you care about. What's your 2 cents on that? Do you think that's just a terrible idea? Because I do think a lot of teams will start doing that. And
Yep.
furthermore, we did see, you see the pros of that with meme coins. Like I remember when WIF went
Sure.
parabolic, one of the reasons WIF went parabolic was because, I mean, the supply was out there, it
Yep.
was all gone. And then when you start growing enough, if an exchange wants to list you and all your tokens are out, they can't buy a block supply. So they have to buy it on the open market. If they're buying coins on the open market, what happens to that? It's going to go parabolic. Now, I'm not saying just do it for that reason, but I spoke to someone who confirmed that a lot of the big exchanges had to buy WIF on the open market because they didn't have a chance to get it otherwise. So I just think, like, in the spirit of blockchain and transparency and decentralization, small percent goes to the team with a standard, monthly vest, yearly vest, whatever, and otherwise just launch the whole enchilada.
Yeah, that's a great point and a great question. I mean, I think you have to separate the roles, right? So for the team itself, I am 1,000% of the camp that there should be vesting, right? You don't want these incentives, and we've
Yeah,
seen it countless times in the past of like the team unlocks. It's even a meme these days, right? On Twitter, right? You see
100%.
these like these announcements like, oh, my time at X and X company has been great, and I'm leaving now.
And then the
Vesting.
meme. Yeah, vesting clip for each. I
Exactly,
love
exactly.
those.
Like you've got to have vesting, align the long-term incentives. I'm a huge fan. I think more projects should do it of KPI-based vesting. So it's not just
Mm,
like, oh, we stall, we wait around a year, then we get our tokens. Like, no, you have to grow the TVL and sustain some level, or we have to reach whatever metrics are relevant for your growth, for your token holders to succeed. Like you should unlock as a team based on
I
success,
like
based on
that.
KPIs, not just based on time passing. So I'm a fan of that approach. Now, vesting in terms of like community tokens, there are pros to what you're describing. Like, and let's remember back in the 2017 days and these ICOs, like a lot of these ICOs were like literally 100% of the supply of tokens was being sold at the ICO. It's like,
Yeah,
that's it. There's no more
yeah,
tokens being made, right? So if you want to buy
yeah,
tokens,
yeah,
you have to buy them on the market. These days, it's hard to absorb all that sell pressure right at
yeah,
day one, right? Like all else
yeah,
equal, if you have 100% of the tokens out there, even if you have like a relatively small FDV, like 25 million is a pretty small FDV, these days for most crypto projects, that's all else equal. $25 million worth of sell pressure of potential airdrop sellers, right? Or people who've
yeah.
received it that
Well
you have to
said.
absorb if you're trying to
Yeah,
defend the price and you don't want this crash in a token price. So as much as we malign the kind of low float, high FDV launches, and I do think FDVs are way too high in general and need to come down, there is a reason for not launching 100% of your supply from day one. And you do kind of see this, like people don't think about this, but stocks themselves when they IPO, like there's no fixed limit to the number of shares of Apple or these other
yeah,
companies. Like they can issue more shares anytime
yeah,
they want, right?
yeah,
And so I think crypto again has obsessed with the like fixed cap concept from Bitcoin and kind of like drawn the wrong conclusions just from copy pasting Bitcoin without thinking about the underlying reasoning. Like Bitcoin is trying to be a form of money and a hard form of money or value competing against an inflationary currency. yes, like a fixed supply makes total sense there. But in terms of like an asset that tracks a value or like, has rights to revenue, like, the claim protocol revenues, fixing your supply is actually much less important than like demand and the actual underlying revenues existing in the first place. So long story short, I would not necessarily go for like all the tokens out there from day one. There's some pros, but if you want to do that way, you just have to be careful and think through things and make sure that you're not going to end up shooting yourself in the foot because your token immediately drops, 90%, and then now it's a dead project and it's really, really hard to gain momentum back.
I love it. Maddie, what an episode. Any hot takes, any Legion news, heck, this episode's going to air mid-Jan 2026, of course.
Right.
Any hot takes, anything to leave us with before we let you go today?
Yeah, my hot takes, just to continue what we've been talking about, like, valuations need to come down. I think, projects are a bit, let's be honest, like a wave of VC activity did drive up valuations last cycle, and we're still kind of metabolizing that. A lot of those VCs, you'll notice, aren't around anymore because they paid out valuations that weren't realized. And so we're still metabolizing this. And so that's one of the reasons why at Legion, it's so important to find those projects and those founders that organically want to reach the retail community and give retail the right valuation that's fair, right? So we've had many different projects on Legion where they'll be raising a current VC round, in the same time as a Legion sale, and they'll give a discount, for instance, or at least the very same valuation to the community. So we'll see valuations come down, but ICOs are not going anywhere. I think they'll become more and more relevant. And airdrops, these days, my other hot take would be just airdrops are industrially farmed these days, right? You have so many bots and Sybil farms spun up that it's mostly noise, doesn't lead to holders. And I think you'll continue to see, ways like ICOs where you have incentive, you have skin in the game, you have greater than zero cost basis as the way to distribute tokens in the future.
I love it. Maddie, wouldn't that be? Where can we find Legion? Where can we find you personally before we let you go today?
Yeah, appreciate it. Thanks again for having me. You can find Legion at legion.cc. So that's our website, legion.cc, or on X, legion.cc. And you can find me on X at Maddie_ is my handle.
Great handle. Folks, what an episode with Maddie O'Connor, co-founder of Legion. Absolute banger. Masterclass on ICOs, IDOs, launchpads, SAFT rounds, you name it. And of course, Legion's bread and butter merit-based compliant token offerings. Huge shout out to Maddie and the team for making this happen. If you guys enjoyed this one, I hope you did, please do subscribe. That would mean the world to my team and I. Speaking to the team, love you guys. Thank you so much for everything. And back to the listeners, keep on growing those bags and keep on staying healthy, wealthy, and happy. Love you guys, and we'll see you on the next one. Ciao.